Hey, good afternoon. Joined with here, Mitch, as we talk about what's going on in this market. It's kind of it's interesting to say the least. And Mitch, I'm a little surprised, honestly, that I don't see your hair on fire right now
Yeah.
with everything that's going on.
Well, so you,
I'm getting the questions a lot, so I know that you're getting them a lot with, "Hey, what is absolutely going on here with the interest rates and the volatility there?" But, before I guess we get into the thick of things, game 1 of the Stanley Cup Finals is tonight.
can't
So,
wait. It's going to be fun.
um, are you watching? Are you a hockey fan?
I am a hockey fan. I am watching, and I don't have $1,000 to shell out to try and find a ticket. So I'll be watching from the comfort of my own home and enjoying it with my wife.
That's all they are, $1,000 for tickets?
That's what I heard yesterday. So I had some friends who were going, and they said that's what they paid for them recently. I'm
Well,
sure
I
they're up
reached out.
high. I'm sure they're up high. They're not down low or at the blue
Yeah,
line or anything
the
like
very
that.
high nosebleeds.
Exactly.
I reached out to some of my contacts who have, suites and tickets and that, just to say, "Hey, if you got an opening, right, you got my phone number, give me a call."
Right. And did the phone ring?
Not yet, but
Not
I
yet.
mean, game's still 3 hours away.
Understood. There could be a last minute cancellation. You're gonna have to just show up.
Yeah. So, yeah,
Nice.
sorry, Brent, I'm leaving you home with the new baby by yourself. It's,
Exactly.
Stanley Cup Finals.
And the door will be locked when you get home, Matt. Be careful. And lock changed.
Yeah. Yeah,
Understood.
very much. So,
Yeah.
yeah, Mitch, interest rates, it's
Yes.
topic of conversations every day. And what
Yes.
I heard from some other folks, right, in the industry was, gosh, they went way up, they came back down a little bit. They're just bouncing all over the place. It feels
Right.
like I mean, they're not bouncing down too far, right? We're not hitting back down to the threes, but
Correct.
it's going up. And I've heard that they're going to raise it another half point when the Fed meets again.
Yes. So one, thanks for having me back on. Good to see you again. You look well rested, so that's good. Or
It's
maybe you have a
it's
little cover up to on today.
good that I look that way, right?
Yes.
With a 1 week old.
Exactly. Fire on hair. I do have a wig on today. Obviously, if I really had a wig on, I should have probably put more hair on it too. But I guess I went for the the more natural look. But it has been,
Distinguished.
yeah, yeah. It has been some interesting. Well, really, since January 3rd of this year, I could go back to where the market just took off real estate wise. Valuations took off. Rates were still fairly in the mid threes, creeped up to low fours, still good. Market still continued to go crazy with people bidding up the properties, et cetera. A lot of volume. And then things started getting looked at with all the inflationary pressures that all of a sudden kicked in for a lot of various reasons, which I don't want to get into today, all those reasons for it, but we're all living the reality of it. And then the Fed stepped in and said, we've got to tame the inflation. How are we going to do that? One way is they raise what's called the federal discount rate, which is what you alluded to today. Jerome Powell, Fed chairperson, today they raised the rate 75 basis points. The hope was 50, the fear was 100, and we got 75. And what that means is they're raising the rates that banks get charged to borrow money for 1 day. So that's a short-term interest rate that is a barometer of what's happening in the economy. It's not a mortgage rate, it's not a car loan, it's not a home equity line of credit. It's a variety of things that are aligned with that because everything is indicated based on what the federal discount rate is. But it's not a 30-year fixed rate loan. But it is indicating all the things that are concerned right now. So we did see mortgage rates go up. Just to reiterate, yes, they went up a couple weeks ago. They came back down actually about a quarter to 3/8% for about a week, and then they went right back up again after that. And then the last 3 days, so Wednesday to today, we were at 5.375 on Wednesday, and we're roughly at 6.25 today. So we've seen quite a move in a short amount. I mean, we're talking 4 business days. Rates went up almost 1 full percent, which is it's unheard of for that kind of movement. As far as anywhere in past, we could actually look at that kind of swing. And so it's caused a lot of concern of what impact is that going to have on borrowing, on cost of house or housing prices, on how many the volume of movement of homes. Is this going to create a more balanced market for buyers and sellers? Will it last a long time? These are the questions I'm getting every day now, and they're valid questions. And it's just interesting times. We're going to work through it, kind of one transaction at a time. Um, the good news is, like, I have a wonderful chart that goes back with 30 years of rates, and it gives the average rate for every year for 30 years. And in 2008, the rates were right about where we are right now. And that was right before the craziness happened in 2008, 2009, 2010, which we're not in the same situation today, far from it. But it was times, we're talking 12 years ago, 14 years ago, that we were looking at that. And it's, here's that cycle. We have 8-year cycles of a lot of different things. It's very commonplace. So then after that, rates started coming down a couple years later, which is the other thought a lot of people are saying. I don't know how deep you want me to go into that, but that's kind of the topic of our conversation today is all of that.
Yeah, as I remember back when I bought my first house, and it's in that realm that you'd mentioned, right? 2008, I bought my first place, and it was 6%. Which my only question was, hey, is that good, right? Am I getting a good rate? And I was a 23-year-old kid, so the answer was, yeah, that's a great rate. That's the lowest that we could do at the time for the FHA, the down payment that I had, et cetera. And I was good with that. I was good. Hey, if nobody's getting half of what I'm getting, then my credit's at least good enough that I'm doing okay with it, right? So historical average around 8% over the last 30 years. I know it's right about 6%. So we're right there into the thick of things. I think we've kind of gotten ourselves conditioned to a point that, gosh, I need to have an interest rate that starts in the 2s, the 3s, the 1s. And that's just not the reality. I think for most folks right now, there's so much anxiety around the unknown. Because there's such volatility in it. It's going up, it's stabilizing. No, it's shooting back up. What do I do? It's causing some folks to stand on the sidelines. And, I think our conversation, Mitch, is around buyer confidence in this, right? What is the perspective that they should be looking at that maybe most folks aren't coming into the conversation with when you're talking to them?
Right. Well, I think the bottom line decision to buy a piece of real estate hasn't changed, whether the rate's 3% or 6%. If you're paying rent, you're paying 100% interest. I mean, it's become a cliche, that comment, but it's also a reality. And the fact is, you own nothing. You're not gaining equity. You're not paying down a mortgage. You're not getting tax deductions from the interest on the mortgage. So you're kind of just status quo in that position. And my conversation is, it's very much about affordability on a monthly basis, whether rates are 3 or 13. If you can afford to buy a home, it will always turn out, always is a tough word. It has for over many years turned out to be your greatest asset and net worth builder that is affordable because you're leveraging so much to the point of you're able to put 3 or 5 or 10% down on a $600,000 home. You don't need $600,000 in cash to actually buy a house. You only need $18,000 if you put 3% down. I mean, and you can leverage the rest as long as you can afford the payment. So I'm starting with that conversation and reminding people, because I've been dealing with some people when rates were in the 4s and 4.5 to 5, who just didn't find a home, and now they're back in the market again and saying, hey, there's more available now. I feel like I'm ready to jump back in. It might be a better time, but then the rates have gone up. So we're revisiting affordability numbers. So if it's affordable, it's still a wonderful decision to consider buying a home, because what else are you going to do? You're going to continue to rent. And here's what this market's causing. In my opinion, we're going to see rents go up again, because the fewer people that move, they have to rent. That means fewer rentals are available, which means landlords have the ability to raise rents because there's supply and demand concern. Just like it was on the housing side of things of supply and demand, more buyers, fewer sellers. valuations went up, a lot of competition. And I think we're better off having a level playing field on the real estate side and some negotiations
Mhm.
versus the rental side. And you're being forced to pay it. Otherwise, you're going to have to move out. And then you got to go do it somewhere else and come up
Yeah.
with all that cash up front. A couple months, security deposit, move, pay for movers. They're slammed right now. They're busy because people are, I mean, it's just the vicious cycle on that end. So I think if you can afford to buy and the payments still make sense, it's still a really good investment.
Yeah, I'm with you, Mitch. And I when I'm talking to folks, I also say, look, hey, take this that I'm biased. I'm in the real estate industry. I'm passionate about it. So that doesn't mean that I'm wrong in the fact that home ownership is a proven path to wealth. And I don't think that changes regardless of what the interest rate is. You're going to see, that opportunity continue to be there as homes appreciate. And
Right.
and I was chatting with one potential buyer who was talking about, as rates are going up, I'm going to have to wait until the home prices come down. And unfortunately, I just don't see the numbers working out to their favor. I still don't think they're going to be able to outsave even if the rate or home values drop a little bit, because if they drop 10%, which is a huge drop, that's a massive drop in value.
Mhm.
The interest rates are, if they go up 1 point, you're still in the exact same place as far as affordability.
Right.
And if you make the minimum payment over 30 years, you pay the same amount for the house.
Correct. Exactly. So to your point, same thing. It's just it's a psychological thing that is real, and we all have to take it into consideration and address it. But when rates move up as quickly as they have, people just say, "Oh my goodness, what do I do now?" What we do is just review the numbers again because it's all about the numbers and comfort level. And find a home that you really love and like. And again, you now have the ability to actually look at a home, think about it for 24 hours in some cases, and say, do we want to make an offer? As opposed to starting to write an offer when you're walking through the third bedroom. You're like, okay, I'm almost done with the offer. Here we go. Sign on my phone here on my tablet. I mean,
Yeah.
that's what was happening. So I think it's a
So
little bit better experience.
yeah, agreed. And we go back to our last conversation we had last month about your lock and shop program, right? I
Mhm.
can lock in today's rates. So even if they're variable, they're going all over the place, they continue to go up. Well, I'm locked in this rate that I have a timeline that I can go shop for a home for. And that's
Correct.
a fantastic program. You've also shared about another option, which is called a 2-1 buy down,
Hmm.
which can be very advantageous for folks in there, and want to get into that here next. But it, when I hear folks say, "Hey, I want to wait until the interest rates come down before I get back into this market because I'll be able to afford more home," well, if the values continue to go where they are, you may still miss out. And if you get into a home today at 6% or six and a quarter, six and a half, let's call it even 8%. If interest rates 2 years from now are lower, you have a great opportunity to refinance into a lower rate. I cannot
Correct.
go to my landlord and say, hey, interest rates went down. I'd like to renegotiate my lease. You're not going to have a whole lot of luck with that unless there's a lot more rental availability. And we're just not looking at that trend as a potential option. What's your feeling on that, Mitch?
Well, I agree with that. You won't be able to do that. So the question is, will rates come to a place that will make it make sense to refinance? 2 years ago, we had that. It was this perfect storm of everybody who owned a home that could refinanced, and it worked out really well because we had appreciation, lower rates, ton of equity, cash out refinances were very popular. And people were buying, excuse me, people were buying other real estate or paying off debt or whatever they were doing with those
Buying a
funds.
boat.
Or, yeah, eliminating mortgage insurance. I mean, there was a variety of reasons for doing so, and it was a wonderful opportunity for people to save money. I'm hopeful that we'll see that trend again because there is a trend of when rates move up as fast as they have, about 18 months to 2 years after that stops, we see a retraction of rates going down, and then hopefully they're down sufficiently enough to look at refinancing. And a kind of a rule of thumb is we'd like to see a 1% reduction in the interest rate to consider refinancing. However, if you have a very large loan amount, it could be a half of 1% and it would still make sense. So it just depends on how that plays out. But you brought up the program that's in our industry is called a 2-1 temporary buy down loan. A wonderful tool we used many, many years ago to help people kind of, the way I'm describing now is kind of take the edge off of a higher rate payment for the first couple of years, and they work their way into it over those first 24 payments. It's not a risky loan because it's a 30-year fixed rate loan. And the temporary buying down of the interest rate, which I'll give a few details on in a minute, are known the day you talk to me about that program, and we have a loan amount that you're going to define once you find a home. So going into it, everybody knows what the payments are going to be in year 1 and year 2, and then year 3 through the 30-year term of the loan, if someone keeps it that long. So it's a great option. I'm not sure, and I don't want to kind of make some assumptions, but I'll throw out some ideas. And that is, if you're in a position where you make an offer to a seller and ask the seller to maybe now participate in some closing costs, some of those dollars can go towards the cost of doing this 2-1 buy down loan. The 2-1 buy down loan fee, and it's not even a fee, it's a prepayment of monthly payments in advance at closing, calculates out to be 2.2% of the loan amount. So if someone was to borrow $400,000, that would be $8,800. That is taken at time of closing and placed into an account that's called an escrow account. Those funds sit there, and each month the lender will pull from that account of money that got deposited at day of closing to help offset what the full payment should be. And we use an example. So let's say the interest rate is 6.5% for easy numbers. And so the 2-1 represents, the first 2 represents 2 percentage rates below the actual mortgage rate in the first year. So if the rate is 6.5% on the 30-year fixed rate loan, which is what it is, the 2% reduction would be 4.5% in year 1. So if the payment at 4.5% in year 1 was $2,000 a month, then the payment, that's what they would pay. However, at 6.5%, let's say the payment was $2,500 a month. That extra $500 is sitting in an account that gets drawn from each month for those first 12 months. So buyer pays $2,000, lender pulls the $500 out of this escrow account of the deposited funds at time of closing, and the full payment of $2,500 gets paid. That's year 1. Year 2, the rate would go from 4.5% to 5.5%. That 1% below the mortgage rate of 6.5% is the one of the 2-1 buy down. So now you have a 5.5% payment. That payment might go up $250 from the previous year. Now you have that money still sitting in that account with the deposited funds at time of closing. It gets pulled from. That happens for the next 12 payments. And now you're in year 3, you're going to pay $2,500, which was the 6.5% from the very beginning. That payment never changed. It just got prepaid by someone. And there's really 3 ways someone can pay that. The buyer can pay it at closing. The seller can pay it. The lender can pay it. Or it can be a combination of all of us, just to making sure we get to that 2.2% or 2.2 points to cover that full expense. So it's a great solution for some comfort there.
Yeah, without a doubt. And I'm with you. I'm looking at, okay, this home's been on the market for a moment, right? I could get them to take 10,000 off the price, or 15 maybe. My payment might be a little bit cheaper, or I could get them to do this 2-1 buy down and save quite a bit over that time. Right. And I'm thinking about this just mathematically for me, right? If I were to do something like this, let's say that, my monthly payment was going to be $2,500 a month for this mortgage at 6%. Well, if we prepaid that, now I'm down to 4 for 2 years, or for a year. I'm down to 5 for another year. Well, if I'm still making that $2,500 and the extra is going to principal, how much faster did I just create more equity and go much further ahead by just making a payment that I would have already been making anyways, right? I just commit to making it day 1 instead of, at the end of month 24.
Certainly. And that's one way of accomplishing prepaying your loan and using other people's money to do that, because that's really what you're doing in that case. Um, the reason we use that program, well, when we use that program, we also want to make sure that the buyers are, one, comfortable, two, can afford this true 6% note rate or 6.5% rate. We have to qualify them at that note rate as if it's just a regular 30-year fixed rate loan. So there's no difference in qualifying. But oftentimes it's very helpful for people who maybe just had a child like you, and maybe someone's staying home for the first year or two and then going back to work. That, again, takes the edge off of that higher payment temporarily for those first 2 years. Some people get some people, if you work in like for the police station or firefighters or what have you, there's a very defined increase of income every year. They know it when they join the academy and they go into training and all that. So as your income goes up, so does that payment. So it makes it a little easier to afford it. So there's a lot of thought that goes behind, should this be a good loan for someone to consider using, and can they afford it in year 3?
Yeah.
So it's important.
Yeah, well, it goes back to kind of safe investing in real estate. If you can afford to keep it, you should never lose within real estate. So,
Correct.
right, let's not, okay, well, our max is here, but when this changes and it goes up to here, I can no longer afford it. That's beyond your means, right? We want to be able to afford it, even to the extremes. And there's other programs as well, adjustable rate mortgages. Some of the forecasters that I'm chatting with have mentioned they believe that a year from now, 2 years from now, interest rates are going to go lower because of what's happening politically, right? We're heading into elections and we're going to have campaign season and election season. That's beyond my expertise, right? I'm good at some things, and forecasting on some of that's a little bit beyond my scope. But if you are confident that that's something that's going to happen, maybe some of those other programs are more beneficial. And the 2-1 buy down is really not nearly as risky, right, as an adjustable rate mortgage, because you know what that's going to be over the long term.
Correct. Yeah. It's again, it's a 30-year fixed rate loan, known from day one, and then lower payments just because you prepaid for it. It's no different than putting $8,800 in your bank account and drawing $200 a month from it to help make your mortgage payment.
Yeah.
It works the same way as needed, right? If you don't need it, then you can make that full $2,500 payment. In your example, prepay your loan, pay your loan off faster than 30 years, and build equity much quicker.
Yeah.
So there's a lot of benefits and perks that come along with that.
So, overall, I think that, the emotions behind it, with the rates being volatile, it's making some folks nervous. Overall, Mitch, I think you and I agree, we can still safely get into this market at this point and say, okay, here's how we get in, and this is what it's going to look like. Because, if I'm just getting married, or I'm having kids and I've outgrown the house that I'm in, or I'm, God forbid, getting divorced, or somebody passed away, people buy real estate still based on things that have to happen, or they do happen, right? Job transfers, take your pick, and they're still going to be buyers. I remember when I bought my first house in 2008, and I heard a lot about foreclosures and things happening. I said, okay, well, it's probably a good opportunity for me to buy. Now, it was good for me in that situation. Not that I felt good about people losing their homes by any means, but just because it's bad in one segment or for somebody in particular doesn't mean it's bad all around, right? There's going to be opportunities, I think, in any market for those who, okay, I understand the pros, the cons, and I feel comfortable to move forward, and I'm gonna take the advantage of this and move forward and be in a great position.
Right. Correct. And again, long-term real estate is always paid off, and as long as it's comfortable and affordable, the starting point is there. And there's a lot of different options out there with properties to pick from. You may not be able to buy that dream home of $650,000 or $700,000 out the gate as your first home, but there's wonderful townhomes and condos and paired homes and different options to consider to avoid having to pay rent continuously. And rent is just fine if the circumstances don't make sense. But if you have the means and you can make that work, then it's really worth consideration. And that's yours, and my job is consult, provide good information, have people make decisions from that, and answer their questions so that they fully understand what they're getting into. And if all that aligns and comes together, which typically it does when it's affordable, then you get the fun job of going out and looking at a bunch of fun homes and seeing how people live and paint walls different colors and wonder how that all got that way. But you have paint can change anything. So, and carpet is a miracle. Those two things really change the dynamics of a home. So,
Yeah, very much so. I think getting into the game matters. If you can afford to get into the game, get into the game. If it's here, can you step up into that next home? Can you keep the first home, create it as a rental? Now you have additional income stream, you have additional market appreciation,
right.
and continue to buy and acquire more homes over the course of 5, 10, 15, 30 years, whatever your
Sure.
desire is. And you're looking at it, 15 years from now and saying, wow, I'm really glad that I did, because here's what we're looking at today.
Right. Yep.
Yeah.
And all people have to do is talk to other homeowners, and they'll give very similar stories across the board because we've been in a very favorable real estate environment.
Yeah.
And Colorado proper of Denver, all the different counties that we're all familiar with that most people live in have stayed strong and will continue to be strong. There'll be a little fluctuation here coming up, I think, but it's not. I think 10% would be a dramatic drop. I don't think it's going to be that, but I think there may be just, again, real fair negotiations around contracts. And I'm hopeful because that just provides a better experience for everybody. So,
I agree. It's a little bit easier on the pricing. It's a little bit easier on the negotiations, right? When it's not as crazy as it was the last 2 years.
Right. Yep. And there'll be those outlier homes that there's 15 offers on because it's just a spectacular property, priced right, and several people really want it. And you'll see those one-offs. They're going to continue to happen. They've always happened.
Yeah.
But I think for the most part, there'll be a lot to pick from over the next 30 to 90 days coming into the summer and then end of summer.
Well, gosh, even when I bought my first place in an extreme buyer's market that we were in, there were multiple offers on the house that I bought. It just worked out that I had the best offer, right? It's going to happen in any market, I think. Yep. So, Mitch, again, I appreciate you taking time as you invest this here with us so we can share different programs to help people feel comfortable. We can share about, the resources. You and I are fairly confident that, yep, things are changing, but since you and I are paying attention and looking at what's going on in the market, we feel confident that we can navigate this ship around the iceberg and not let somebody become the Titanic.
Exactly. Yeah. And that to me is being armed with information and program selections or home selections that meet most of the needs that people have.
Yeah.
And the rest is just their comfort level and moving forward. And from there we can take it. That's the easy part. Getting the loan closed and finding the real estate is going to be a little easier now. It wasn't so much before, but yeah, that's what we're here for. We're just here to provide information and give good guidance and advice and support any questions and opinions that are being asked for. So
we started this, Mitch, with talking about the Stanley Cup Finals. I'm going to ask you for your prediction. Who wins the series and how many games?
Avs in 7. I think it's going to be a 4-3 win.
Okay, so are you going to get tickets there for Game 7?
Well, those will be probably $5,000 by then. They appreciate like a house does.
Yeah, very much so.
And how about you? What's your opinion?
I think Avs are going to take it in 6.
All right.
It's going to be a good matchup. I'm excited for it. I love playoff hockey.
It's amazing, and I hope everybody stays healthy because that could change the end result for sure.
Yeah, without a doubt.
So, yeah, great. Excellent.
Well, again, thanks so much, Mitch, and we'll see you guys next month.
Look forward to it. Thank you again, Matt. Have a good afternoon and good luck with fatherhood.
I appreciate it. Thanks.
Thank you.